Hey everyone, it's Wolfgang. High interest rates are damaging the U.S. economy. So here's some background. Interest rates in the U.S. have been too high for too long. There are a lot of reasons for this. I'm going to explain why. I'm going to explain the damage they're causing to the U.S. economy, and I will explain what things will improve once the Fed starts lowering interest rates. So there's been a claim by the financial media and by the Federal Reserve chairman that the job market is strong. We've been hearing that from the financial media for many, many months, and also by the U.S. Central Bank, Jerome Powell. That fails to count two groups of people. The job market is strong. This claim is ignoring two groups of people. The first group, the long-term unemployed. Someone is long-term unemployed if they've been without a job for 27 weeks or longer. They are not counted in the unemployment rate. If you've been without a job for 27 weeks or more, that's a little more than half a year, you are no longer considered unemployed. So when you hear this claim by the chairman of the Federal Reserve or the financial media that the job market is strong, just remember, if you've been without work for more than half a year, you are not considered unemployed. Another group that the unemployment rate does not count, people who have stopped looking for work. They're called discouraged workers. If you've been looking for a job for so long that you just decide to give up, you are not considered unemployed. Those are two large groups of people. People without a job for 27 weeks or longer, and people who have looked so long and hard that they've given up. So whenever you hear the job market is strong, just remember, if you've been without work for a little over half a year, or if you've given up looking because you don't think there's a job, you are not included in the unemployment rate. So there is no, the strong job market is baloney. It's not true. Okay? And you might ask, why is this happening? Back in 1994, a change was made as to how unemployment is counted. That is partly to blame. The unemployment counting was initiated, I believe, in the 1940s, maybe 1940. And in 1994, they changed the counting to be a little more accurate. And what they started doing is they started considering anyone with no job for 27 weeks or longer, they're no longer considered unemployment. They're not counted. And the people who have stopped looking for work are also not counted. So that's millions and millions and millions of people in the United States right now. So the financial media has been carrying water. By that I mean they've been supporting the claim by Jerome Powell and the central bank, the U.S. Central Bank, that the job market is strong. Until recently, okay? Until recently. The financial media is now starting to tell the truth about the job market. If you start watching CNBC or Bloomberg or those or other finance shows, every once in a while you will catch them telling the truth. Something along the lines of, if you find yourself out of a job, you're in for a tough slog. Something to that effect, that you don't want to be without a job right now. The financial media is starting to tell the truth about the job market, finally. But for a very long time, they have been providing cover for this bogus claim that the job market is strong. So why is this so important? Why is the bogus claim that the job market is strong so important? Because the Federal Reserve has two jobs. One of them is to keep unemployment low. So they're claiming the job market is strong and thus we have low unemployment. It's not true. It's not true. Okay? If you know anyone who's been without a job and they're looking, and if you're aware of all the AI-caused layoffs, you know that the job market is not in good shape right now. So the announcement, I believe it was yesterday or today, that the short-term, the new filings for unemployment was lower than expected. You have to understand that there are two large groups of people that are not being counted. People who've been without a job for 27 weeks or longer, and people who have given up looking because they don't think a job is out there for them. So the people who have just lost their job and just filed for unemployment, it really doesn't matter. Not yet anyways, not until they click over into 27 weeks or they give up looking for work. Then they're no longer counted. So the U.S. Central Bank is supposed to keep unemployment low. They have failed to do that. They have failed to do that. The number of long-term unemployed people is the highest since 2021. It's the highest in 4 years. There are so many unemployed people right now. It hasn't been this bad since 2021. And if you remember, that was sort of peak COVID times when the government had basically shut down the economy, forcing many businesses to close and go out of business effectively. It's gotten to that point where we have more unemployed people now than during those times when the government had shut down the U.S. economy. Okay, so this claim you hear when you hear the job market is strong, immediately think long-term unemployed people is the highest since 2021. That is, in my opinion, I know this is a little bit polarizing and I apologize for that. That is a bold-faced lie. That is a lie. And I won't go into the details as to why this claim is continually being made, but there are reasons, and you can judge for yourself or reason for yourself as to why the unemployment rate is being reported as rosy. We all pretty much know it's not. Even the financial media is finally starting to come clean. So in our opinion, the Federal Reserve right now is responsible for keeping millions of U.S. citizens with no job, especially now that AI has started to replace workers and people are being laid off by the thousands. IBM just laid off 9,000 people, and they explicitly said we are replacing them with AI. Right now, people need help finding jobs. Interest rates need to be lower. So high interest rates are damaging the economy by overly tight or restrictive monetary policy. So I couldn't fit everything on the board. Overly restrictive or contractionary monetary policy is when interest rates are too high for too long. So what happens is when people lose jobs, they have difficulty finding a new job because consumer spending drops. Consumers rely on credit cards, for car loans, for home loans. Consumers use credit and businesses rely on credit too, borrowing. And the interest rate for borrowing is quite high right now. That is reducing spending by consumers and by businesses, but especially by consumers. When consumers and businesses reduce their spending, it hurts companies that sell things. It hurts companies that sell things to consumers and to businesses. They sell fewer items. They don't need as many employees. They will lay off employees. So if the Federal Reserve began to lower interest rates and reduce borrowing costs, that would stimulate consumer spending. When consumers spend more, companies sell more. When companies sell more, they need more employees to facilitate that. So right now, consumer spending is not healthy. And the increase in long-term unemployment, I've already mentioned that. We've had more long-term unemployed right now than we've had in the past 4 years. So what are the parts of the U.S. economy that are suffering due to the overly tight monetary policy? Interest rates too high, too long. So the first thing is, we pretty much all know this, the housing market is basically not functioning. Interest rates, borrowing costs for people who would like to buy a home are too high. People cannot qualify for a mortgage. The housing market is in very difficult shape. And when the housing market is not healthy, when people are not buying and selling homes, the jobs that are associated with selling a home or buying a home, that would include painters, people who sell and install flooring, people who sell and install appliances, furniture, landscapers, roofing. Those jobs are suffering. There's a reduced number of those jobs when borrowing costs are too high, when interest rates have been too high for too long. It damages the economy by robbing the economy of jobs. So the housing market slows down or freezes. That's pretty much already happened. If you go on Redfin and you look this up, there are more homes for sale right now in the U.S. than there have been since 2009, 16 years. The number of homes for sale that no one is buying, it hasn't been this high since the great financial crisis in 2008, 2009. That's how bad the housing market has become. Another industry that is hurting, and it may not be obvious how this is affecting the economy, but venture capital invests in new companies, and those new companies tend to hire and pay high-paid employees. A lot of high-paid jobs get created by venture capital. So when interest rates are high, when borrowing costs are too high, a lot of the early-stage companies rely on debt financing for part of their ability to sustain themselves until they can scale up their business and start making enough sales. Venture capital is hurting. They have been for quite a while now. So a lot of jobs high-paying jobs that would otherwise be created by venture capital are not being created. So borrowing costs have hurt the small early-stage companies that need debt financing in some cases. Another problem is when venture capitalists want to sell their portfolio companies before they go public, before they go IPO. People who would otherwise buy those early stage companies, they're relying on debt financing too, and borrowing costs are high. So venture capitalists are having a tough time with acquisitions, with people acquiring their companies. So the venture capital industry, if you look this up online, is pretty much frozen. And it has been bad for a while. So here's a scenario. Here's a hypothetical scenario. Let's say that the U.S. central bank decided to engage in stimulative monetary policy, lowering interest rates. That's justified right now because the long-term unemployed, the number of long-term unemployed is the highest in 4 years. It hasn't been this bad since the government shut down the U.S. economy during COVID. It's justified to lower interest rates because inflation, the other job for the central bank is to keep inflation low, to keep inflation as close to 2% as possible. That's already done. Inflation reached 2.1% in April. So this part of their mandate is done. They should be focusing on the unemployment. They're ignoring the bad job market. They just came out and said the job market is strong. It's untrue. It's inaccurate. So what would happen if the U.S. Central bank dropped interest rates by 25 basis points 4 times in succession? That would be a total drop of 1%. 1%. So interest rates would fall from 4.5% down to 3.5% in 4 steps of 25 basis points, which is 0.25% each. The first thing that would improve consumer spending. When borrowing costs drop, credit card rates drop, the interest rate to buy a car drops. That's a used car or a new car. The interest rate to buy a home drops. So across the economy, when borrowing costs are lowered because interest rates are lowered, that stimulates buying behavior, consumption, spending. It stimulates spending. That's the first thing that would improve if the Fed lowered interest rates in 4 steps down by 1%. The housing market would recover. And the most important part about the housing market recovery is all those trades jobs would start being created again. Flooring installers, appliance installers and sellers, painters, landscapers, roofers, people who sell furniture, those jobs would start to recover. The real estate industry, which is basically frozen over too, it would recover. The mortgage industry, mortgage brokers, real estate agents, real estate brokers, those jobs would start to recover. Another thing that would instantly improve, well, not instantly, but it would improve as interest rates are lowered. It would start to become easier to find a job. As people begin spending again, companies begin selling more and they have to hire more. So it would be easier to find a job. Companies hire more when consumers are spending more, and lower interest rates would make that happen. And probably the most important thing about it, lowering interest rates, these long-term unemployed people, it hasn't been this bad since 2021. These long-term unemployed people would be able to find work again. Just remember, if you've been without a job for 27 weeks or longer, you're not considered unemployed. If you've given up looking for a job because you're just frustrated and you filled out so many applications and nothing's happening, you're also not considered unemployed. So that has to stop. That's a change that has to be fixed, because it shouldn't be possible for Jerome Powell or any Federal Reserve chairman to get up on the podium and say the job market is strong when it's not. When there are so many long-term unemployed people that it hasn't been this bad since the government shut down the economy during COVID, it shouldn't be possible for the chairman of the Federal Reserve to get up on a podium and claim that the job market is healthy. That is wrong. That is not, it's not right. And they're using that as an excuse, and I'll leave it to you to figure out why that might be happening. They're using this as an excuse to not lower interest rates. They're saying, well, unemployment is strong, so we don't need to lower rates. It's baloney. The job market is not strong. If you have any questions about this, I'd be happy to answer any questions you have. There's room for improvement here. I don't know if the current central bank employment needs to change, if the staff members need to change, or if somebody at the Bureau of Labor Statistics needs to look at the data they're reporting, because the payroll provider ADP, I believe it's ADP, keeps reporting that employment is down hard. And they're a large, I think they're the biggest payroll processor in the country. They keep saying that employment is awful, that jobs are down. And the Federal Reserve keeps getting up on a podium and going the opposite direction because of the Bureau of Labor Statistics data. I don't think the data is accurate. I wonder if it's been weaponized. And I won't go into why we think that might be happening. There may be political reasons. Not sure. Can't prove it, but we're suspicious that the Bureau of Labor Statistics data is unreliable. If nothing else, the long-term unemployed people, the highest in 4 years, is undeniable. You can find this online. Go online and look up long-term unemployed, highest in 4 years since 2021. You will find that reported. So the government shut down the economy due to COVID, and that put a lot of people out of work. And we're right back at having that number of people being out of work for a long time. So they shouldn't be able to get up on a podium and make this claim. The job market's not strong. I'm just being forthright with this issue. I think the Bureau of Labor Statistics staff may need to be changed. The staff at the Federal Reserve, the U.S. Central Bank, needs to be changed. I'm not sure how to make that happen, but we need more accurate reporting. And the financial media is starting to tell the truth. Finally, they're starting to tell the truth that the job market is shaky. So if you have any questions, please post in the comments. I really want to thank everyone for watching, and have a great day.